Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. We're going to discuss Advanced Financial Reporting Module-02. So in my Module-2, it is the continuation of Module-1. There we learned conceptual and regulatory framework for financial reporting and the need for a conceptual framework is the continuation. We have seen the secondary qualities of reliability, faithfulness, representation. So what is faithful representation? If we see here, then faithful representation means that the numbers and descriptions match what really happened. And faithful representation depends on completeness, neutrality, free from error. So, to be reliable, information either must represent faithfully the transactions and other events in purpose of present or could reasonably be expected to represent. So we can say faithful representation is that the numbers and description match what really happened. Substance over form. So substance over form is the treatment according to the transactions, so that the real effect of the transactions on the business is recorded. So substance over form is the treatment according to the transaction. That means the real effect of the transactions in the business is recorded. So if information is done present faithfully and transactions and other event that it purports to present, it is necessary that they are accounted for and presented in accordance with their substance and economic reality and not merely their legal form. So, substance over form is the treatment according to the transactions, so that the real effect of the transactions on the business is recorded. So neutrality, to be reliable, the information contained in financial statements must be neutral, that is, free from bias. Financial statement must be neutral, it should be free from bias. Prudence. Where a statement liability or expenses, because the financial statement would not be neutral and therefore not have the quality of reliability. So need the prudence. So completeness. The information in financial statements must be complete within the bounds of materiality and cost. That's the vital. An omission can cause information to be false or misleading and thus unreliable and deception, unreliable and deficient in terms of its relevance. So the information in financial statements must be complete within the bounds of materiality and cost. And primary qualities relating to presentation. First of all, understandability. So, accounting information should be readily understandable by the users. Accounting information should be readily understandable by the users. To have the accounting characteristics of understandability, the accounting information must be presented in a manner that users can understand the same without having expert knowledge in financial analysis. So, understandability is it should have the understandability by the users. So, in financial accounting, it would be the relevance, the materiality, reliability, understandability, comparability, the comparability. Users must be able to compare the financial statements of an enterprise through time in order to identify trends in the financial position and performance. So, the purpose of comparison is to detect and explain similarities and differences. Accounting information should be comparable across different companies and over different time periods. So, users must be able to compare the financial statements in order to identify trends in its financial position and performance. So, compliance with accounting standard, including the disclosure of accounting policies used by the enterprise, helps to achieve comparability. So we can say that comparability is the must for comparing with another organization, within the organization, within the different period. Okay, so, and we know the accounting qualities that accounting information has specific qualities. The benefit is the greater than cost, and it has some understandability, need the decision making and the usefulness in decision making. It should be relevance, it should be reliable, it should be periodic value, it's the predictive value, feedback value, timeless and verifiable. It should be comparability, neutrality, and representative item. It should have. And we know the component of financial statements. Now, the element of financial statements. That means elements of financial statements are assets, liabilities, owner security, revenue, expense. So if you see assets, what is asset? Assets are economic resource. That means assets are economic resource controlled by the entity or organization as a result of past transactions or events from which future economic benefits may be obtained. Future economic benefits. So we say that assets are economic resource controlled by the entity as a result of past transactions or events from which future benefits may be obtained. Assets have three essential characteristics. We have seen here that means future benefit, controlling access, and previous transactions or events, and assets are current asset and fixed assets. So current assets are cash and cash equivalent, accounts receivable, prepaid expense, raw material, inventory, short-term investment, inventories. We know also inventories are three types: raw materials, work in progress, and finished goods. So, and fixed assets are lands, buildings, factories, furniture, equipment, etc. So we can say that assets are economic resource controlled by an entity as a result of past transactions from which future economic benefits may be obtained. Now, liabilities. So liabilities are obligations of an entity arising from past transactions or event, the settlement of which may result in the transfer or use of asset, provision of service, or other yielding economic benefits in the future. So liabilities are obligations. As like I said, liabilities has three essential characteristics. It's the responsibilities of other the entitles settlement. We have to settle it, and duty of responsibility, obligation, that entity leaving the little or no discretion to avoid it. It cannot be avoided. And transactions or event obliging the entity has already occurred. The transactions or event obligating the entity has already occurred. And liability has two types: non-current, current. And currents are cash, dividend payable, accounts expense, accrued expense, short-term notes payable, accounts payable, taxation payable, earned revenues. And non-current, bank loans, mortgage, others loans. So we can say that liabilities are the obligation of an entity arising from the past transaction and have to settle it. And if want to settle that, with the transfer of asset or use of asset, provision of service, etc., that has economic benefit in the future. So now equity. What is equity? We can calculate equity. If we deduct liabilities from the asset, then we'll get the equity. If we deduct liabilities from the assets, then we'll get equity. So equity is the ownership interest in the assets after deducting its liabilities. And revenue is the increase in the economic resource. That means revenue is that the regular activities, income from regular activities. And expense is an decrease in the economic resource. Expense is the expense for regular activities, either by lowest of outflow and reduce of asset. Gains are increase in equity from peripheral or incidental transactions or events. And losses are the incidental. Losses are decreases in equity. Loss. Okay. So revenue are increases in economic resource either by way of inflow or enhancement of asset or reduction of liabilities. It is the regular activities, income from regular activities. And expense are the decrease in the economic resource either by the way of outflow reduction of asset or increase of liabilities. It's also the regular activities, the losses and the decrease in equity. And net income. Net income is the residual amount after expenses and losses are reduced or deducted from the revenue and gain. So, net income is the residual income or amount after expenses and losses are deducted from the revenue and gains. We have net income, we'll calculate gross income, and gross income in the amount that a company make an product less direct expense. This is the regular activities. And from the gross income, if we deduct other expense by operating expense, then we get the net income. So net income is the profit that a business makes, or the money that a business is left with after paying all expenses. So we can say that net income is the residual amount after expenses and losses are deducted from revenue and gains. It's okay? So that's all today. So today we discussed the secondary qualities of reliability, presentations, and faithful representation mean that the numbers and descriptions that should be matched with the really happened, and substance over from is the treatment according to the transactions, and neutrality, it should be free from bias, should be prudence, initial data should be it should have the completeness, and understandability, accounting information should be reliable and readily understandable by the users. So that's okay. So thank you. We will see you with my next module. Allah Hafiz.